my co-host for all of that insight. And now to bring in our next guest, that's Dale Smothers, President and CEO of RDS Wealth Management. And so Dale, first and foremost, thank you so much for joining us on this Friday. How do you think through the positioning in the market right now after this latest relief rally, of course, tied to the hopeful piece that we'll get at least more clarity on next week? But how do you think through the market right now?
Yeah, the pathway to peace showed us the optimism, Jenny, that I think the market has been looking for. They're optimistic. The buyers are coming back to the picture here. And so we are looking through. That's the key word. We're looking through this short-term blip in oil. I think you've even seen that with the CPI print. This was the most recent print that came out this morning, the first print that we've seen with how this war is impacting inflation. It was high. It was higher than we would hope, but it was on the spectrum of acceptance, which is why you've seen the market continue to basically just shrug it off as if this is a short-term blip. So right now we are positioning. We're considering this almost a planting season. We've been saying this for the last 2 to 3 weeks. This is the time to position money for our clients. If you've got clients, for instance, that are speculative and maybe need a little bit of growth in their portfolio, we really like the names Amazon, Apple. We like NVIDIA. These would be something we would consider the toll booths for AI. And as that traffic picks back up, we think sentiment changes here over the next couple of quarters. You're going to see these names that have almost become value names start to become growth again. We also like playing dividends for our clients right now. We work with a lot of clients, Jenny, as you're aware, that are close to retirement or into retirement. That stable income is what they're after. So we like names like JEPI, which is an ETF that trades covered calls on blue chip names. We like HDV, a basket of blue chip names that pay strong dividends. And in particular, some names that we like are Royal Caribbean. We really like that, and Johnson & Johnson going into earnings this season.
Okay, and so given all of the, pretty positive catalysts you mentioned in this market right now, how do you also then think through, of course, approaching that deadline coming next week? We see volatility start to pick up.
Sure, and I think that's almost inevitable at this point. We are going to approach that deadline with no clear, in our opinion, no clear resolution, but the de-escalation in itself has given reason to be optimistic. So we're going to see volatility creep in a little bit closer to the end of next week. And again, I think that's just a time to take advantage of these names that perhaps are on sale. Depending on an investor's portfolio, you can look at this as one of 2 different ways. Either a time to reevaluate how much risk you actually want in the portfolio, and when we come through this, and we will come through this, then take action. Don't make any panic sales in a buyer's market, which is what we're in right now. As we approach the end of next week, reposition your portfolio for optimism. And if you need a little bit of growth in names that are probably going to go on sale, like in the tech sector, probably be one of the first ones to be hit, use next week's volatility as an opportunity for you. Again, looking for, by the end of June or July, we are looking for the S&P 500 to be closer to 7,000 points, Jenny. We believe that this market wants to be optimistic. And it will see through this Middle Eastern crisis.
Okay, and so say we do, of course, hopefully see through this crisis happening overseas. What catalyst do you see then continuing to propel? The overall market's higher, like you mentioned, S&P's at 7,000 by July. So you're obviously expecting a pretty solid earnings season, which we'll get a full scope of really next week. But it's going to be a busy week next week, I'm realizing.
A very busy week next week, Jenny, and earnings are the catalyst. The market follows earnings. The market is trading on what we expect to be double-digit growth in earnings this year. I think that propels us higher in 2026. Do we see and close, let's say, December at all-time highs? That's still yet to be seen, because what's going to then be our volatility in a later part of the year is going to be the midterm news cycle, which brings its own bit of volatility every time that happens, especially if we see the House and Senate potentially being flipped. So this volatility will continue through 2026, but earnings takes the market higher.
Okay, and also another thing that could obviously have a more short-term impact, everything does run through oil. The fact of the matter is Strait of Hormuz is still not fully open. So as far as sector exposure is concerned, how do you balance that exposure, considering nothing is really immune from this? And I think the time frame and some of the long-lasting implications are still not being fully read through.
Absolutely, Jenny. And so let's be realistic here. I am optimistic. I am a probably even forever bull. The market moves up and to the right historically, but we do have some things that could change that in the short term. And oil is the biggest story. If oil stays at $100 per barrel or more for 90 days, now we've seen a little bit of a relief. A pressure valve has been released here. But if it stays higher for 90 days, the market suffers. And what I told you is going to take the market higher will then start to take the market lower, which is weaker earnings. We believe strong earnings take it higher. If oil comes through and inflation begins to be a significant issue, and God forbid that we see a rate hike become a reality, the market will not like this at all. So we have to get the Strait of Hormuz open. We have to get the Middle Eastern crisis behind us. And I think the world also realizes this. How do we play this for clients that want a little bit more stability? The simple answer here is options. We like options around the S&P 500. We can protect some downside and still provide upside on all sectors in the S&P 500. Diversity is key. Value, value, value. And like I said at the beginning, I think you've got some tech names that have become value names. Look for opportunities. Stay calm.
Okay, and I liked how you called this planting season because obviously with a lot of the recent valuation resets, things are looking a bit more on sale, at least at these current levels. I know this week hasn't necessarily helped that, but say you were more risk adverse and you still feel like there's this major threat still of uncertainty. How do you go about balancing income with that stability? And you mentioned some of these ETF names that provide obviously that diversification.
Yeah, let's back up and look at a name like JEPI, for instance. You know, this is a fund, and we do this for our clients on individual names as well, selling covered calls on overweight positions. But if you just wanted to do this, let's say, with the idea that you need some stability, you need some income, a name like JEPI right now is providing 8+% yield overall because you're not only getting the blue chip company dividend, but you're also getting the covered call premium. And the worst thing is that the market goes higher and it gets called away from that particular ETF, and they're just going to recycle that money into a different name. Holding blue chip companies right now for our clients is what we're doing. Holding blue chip companies, selling covered calls to collect the additional premium. You've got a strong dividend, additional options premium, it equals income. And then again, one of our key holdings in our income portfolio is HDV. It has performed very well. I wouldn't necessarily call it defensive, but it's got a name, several names in it with moat around those names, and they pay strong and increasing dividends. You go back to a year like 2022, it has been contrarian to the market, still doing well when the S&P 500 is high. But if you look at a year-to-date chart alone, Jenny, I think that tells the story of where the S&P is versus a name like HDV. And again, that's just the value and dividend play that we would recommend for our clients here. I want to be very careful. This is not a blanket recommendation. But if you've got an opportunity here to take advantage of income and stability, a name like HDV provides that.
Okay, and I like that, looking at some of these, maybe lesser discussed, but still very important ETFs and sort of diversifying, broadening out that portfolio, which I do think is very critical right now. But really appreciate it helping us kick off our show today on this Friday. Dale Smothers, President and CEO of RDS Wealth Management. Thanks so much. Now, plenty more to come on Trading 360. Next, it's the big three. 3 stocks, 3 charts, and 3 trades. Rick Ducat will go through the technicals, and Tim Bowen will take us through the trades for Air Test Systems, SanDisk, and Intel. That's next on Trading 360.